This is a download from BFM 89.9, the business station.
Good morning, George. The U.S. market on Friday was focused on a job miss for April, 160,000 new jobs compared to the 200,000 expected by economists. What do you feel about this? Is it all gloomy?
Well, good morning, Julian. From an economic point of view, it just means that we're not having the growth that we expected. Yes, obviously the employment numbers for April, they were a fifth less than the consensus forecast and a third less than the average of the past 6 months. So this is not particularly strong. Also, we had revisions in the two prior months, which subtracted a total of 19,000, but the average work week ticked up by a tenth of an hour, up to 34.5 hours. So it is mixed. The numbers seem to add up to bigger pay packets, but not the strength that we need. And so it is going to have quite an impact on the Federal Reserve policy. The April employment report obviously reflects a slow growth economy that the FOMC has been reluctant to recognize up to now.
Some people argue that this is supposedly a lagging indicator, but I guess you're right in saying that there is some influence on how the Fed will react to interest rates. And where do you stand on this? How much would this drive the interest rate decisions?
We're getting into the political season, so the Fed is likely to be on hold until at least September, and much more likely December after the November elections. And we suspect that will have. We're seeing that this is an indication so far that we're just not growing as much. But if we have an increase in easing monetary policy, that would be viewed as very bad news for the U.S. economy, because it would have been a surprise move by the Fed, which is not expected by the market. So we are watching. Yes, we do see a delay. That is expected given what we've already had in the economic numbers this last week. But if there's more of a downside, more a depressing move in the Fed policy or the implication of Fed policy, then I think that will start to affect our markets.
And I guess the market is also sending a signal because the trade-weighted value of the US dollar against a basket of other currencies, of the major trading currencies, have actually fallen quite a bit so far this year, but has been edging up over the last few days or so. What do you think this kind of numbers from the jobs market have on the dollar?
Most likely we'll see a more of a weakening than a strengthening of the U.S. dollar based on the perception of what our interest rates are going to do. And I think that would be favorable for U.S. exports and for U.S. economic numbers, at least on an external basis, not a direct implication on jobs, et cetera. What we're really seeing more in terms of what's happening is what's happening in China, the fact that China is doubling down in efforts to keep unprofitable factories afloat despite years of pledging to curb excess capacity, is adding to a glut of basic materials floating through the global economy. That is particularly in steel, aluminum, diesel, industrial goods. That has driven down prices and crippled competitors, and it is affecting our jobs over here in the U.S. as well as elsewhere. We're seeing a significant loss of jobs because of this. That coupled with the weak U.S. dollar, we're in flux right now, Julian. It's not certain. I do not see any reason for the U.S. dollar to continue strengthening.
So if you take the view that interest rates are going to continue to be low, and I guess that's a trend that is happening for the rest of the world as well, how does this affect investment valuations? I mean, the market has had a very good run over the last few years. Is the market attractive from a valuations viewpoint at this point in time?
Well, you're right. The bull market, actually, if you take a look, our bull market high occurred just about a year ago, May 21st of last year. Since then, the S&P 500 has recorded a series of slightly lower highs, while the internal condition of our broad market has actually weakened. We suspect that the transition from the bull market to a potential bear market phase has been lengthened because with lower interest rates, It makes bonds less attractive. It also means that there's an increasing number of investors who are aggressively seeking out higher rates of income in our common shares stock dividends. Particularly, we're seeing that in real estate investment trusts. Dividends are most commonly found in large cap stocks, while small cap stocks are generally less likely to offer the same generous returns. So accordingly, we're seeing investors currently under some degree of pressure to sell bonds in small cap stocks in order to increase their commitments to dividend paying the larger cap stocks. So that, I think, will continue as long as the perception of interest rates staying down. And there are fairly significant high yields given, particularly in REITs, over 8%, and in high-yield dividend-paying stocks. That's where I think the interest in the market will continue. But that doesn't mean necessarily that our markets are as strong as they appear to be when looking at the major indices.
Now, the other big news, of course, is the sacking of Mr. Ali Al-Naimi from the Saudi Arabia's powerful portfolio of oil minister. He is Mr. OPEC himself, having shaped oil and oil prices for the last 30 years. What do you think this means for oil prices?
Interesting. I don't think there is a clear-cut definitive answer, either increasing oil prices or decreasing. We're seeing a lot of, yes, it's a very important influence, and it does have an impact. But we're also seeing there have been wildfire raging in Alberta, Canada. They could go on for months unless there's some significant rainfall. The production is being reduced by about 40% of the region's output. That means that there's less supply on the market. It's harder to bring the supply back up. It takes time. It also costs money. So I think we're going to see a fluctuating interest rate environment and a fluctuating price in oil. I believe that we have seen the low in oil prices, and I do see that the trend will continue to the upside. But for those who invest in energy and oil-related stocks, it's more of a commodity trade as opposed to a longer-term investment, unless, of course, one is willing to live with the volatility that we expect to continue for at least the next 9 months.
Thanks so much, George. And it's, of course, dinner time there. You're going for your Mother's Day dinner.
Yes, indeed. It's time. All our families, it's the one time of the year when we can get everybody together. So we do appreciate that.
That's very nice. You have a good one. And that was George Dorland, Chief Investment Officer of Lander Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.